Every price movement in the market tells a story. It might seem unpredictable at first, but there is always a reason behind the rise and fall of price. That reason often comes down to one powerful concept: liquidity. Liquidity is what allows trades to happen. It is the fuel that keeps the market moving, and one of the main ways liquidity is created is through stop orders. Whenever traders open a position, they usually set a stop loss or a take profit level. These orders wait quietly in the background, ready to activate if the market reaches a certain price. When thousands of traders do this, these stops begin to cluster at common points on the chart, such as around recent highs, lows, or whole number levels. Together, they create what is known as a liquidity pool. A liquidity pool is an area on the chart where many pending orders sit, waiting to be triggered. These areas are invisible to most traders, but they play a major role in how price moves. When the market gets close to one of these zones, it often reacts in powerful and sometimes surprising ways. Imagine a situation where many traders have placed their stop-loss orders just below a recent low. To large market participants, that level becomes an area of interest. They know that if price drops slightly below that low, a wave of sell orders will hit the market. By pushing price just far enough to trigger those stops, they can unlock a burst of liquidity, fill their own buy orders at a better price, and then allow the market to rebound. This is why you sometimes see price break a level, move sharply in one direction, and then quickly reverse. What looks like randomness is often the natural process of liquidity being collected and redistributed. The same behavior happens on the other side of the market. When a large number of stops sit above a recent high, that area becomes a pocket of buy orders. If price pushes higher into that zone, the sudden rush of activity can cause a short spike upward before momentum fades and price settles back down. For traders, understanding this behavior changes the way you see the market. Instead of reacting emotionally to every breakout, you start asking smarter questions. Who is being stopped out here? Where are traders trapped? And what might happen after the liquidity is taken? This does not mean that every breakout is a trap. Sometimes a breakout leads to a strong trend. Other times it fades quickly. The difference often lies in whether the move is driven by genuine buying or selling interest, or by the hunt for liquidity. Consider a common scenario. A currency pair has been trading in a tight range for several hours. Stops have built up above the highs and below the lows. When price suddenly pushes past one edge of the range, traders may rush to join what looks like a breakout. But if that move was only driven by the triggering of stops, it may soon reverse once the liquidity has been absorbed. By studying these reactions, traders can learn to be more patient. Instead of entering at the first sign of movement, they can wait for confirmation that price is holding beyond the liquidity zone. This approach can help reduce unnecessary losses and improve timing. At Vestra, we believe that education and understanding give traders an advantage. Knowing how stop orders interact with liquidity helps you see what is really happening beneath the surface of the chart. It shows you how institutional activity, order flow, and crowd behavior combine to create the price action you see every day. Liquidity is the foundation of every market. Stop orders are the signals that guide its flow. By learning to recognize how they interact, you become better equipped to navigate short-term movements and to approach trading with a clear, strategic mindset. Trading always involves risk, and returns are never guaranteed. But knowledge helps you make more thoughtful decisions. And in a fast-moving market, thoughtful decisions make all the difference. Content is for educational purposes only, not financial advice and FSP number.